Okay, you have to admit, it is almost impossible right now to find a food brand that actually grew its sales volume without hiking menu prices a single penny. But somehow, the pizza guys just pulled it off.
Yeah, with exactly flat pricing. It is pretty rare air right now.
Right? So you are listening to Earnings Unscripted, where we unpack what really happened in today's earnings. It is February 23rd, 2026, and today we are looking at Domino's, ticker DPZ, and their fourth quarter results.
Yep.
And Miro, it looks like a massively strong quarter on the surface, maybe a little complex under the hood. What is your immediate read here?
It's a brute force volume win, really. I mean, revenue came in at $1.54 billion. That is up almost 34% quarter over quarter from the $1.15 billion in Q3. And diluted EPS hit $5.35.
Which is, sorry, quick reminder, this podcast is just our personal opinion and definitely not financial advice. But $5.35 is a really big step up from last quarter's $4.08, right?
Exactly, a 31% jump. But look, the weird part to me is the market reaction, because in the extended hours before the call, the stock took this bizarre brief dive down to $3.84.
Jeez.
Yeah, but by the time the regular session ended, nothing. The tape just shrugged. It drifted to a close that was basically flat, down to fraction of a percent, right around $400.
They really just ignored it, which is wild considering the total flex the CEO made on the call. Did you catch that? They only closed 7 U.S. stores all of last year.
Out of 7,000.
Yes, 7 out of 7,000, while their competitors are literally shuttering hundreds of locations left and right.
Oh, he was definitely dunking on the competition. I mean, they are operating like a machine. Company-wide operating margins stayed basically flat at 19.3%, but here's the catch. That metric hides a really nasty bleed on the corporate-owned store side.
Wait, can I jump in? Are you talking about the car crash thing? Because that was my favorite bizarre detail in the whole filing.
Yeah. People think they're buying a global tech and pizza stock, but really, you're underwriting a massive fleet of drivers. Surging casualty insurance claims completely tanked their corporate gross margins by over 5 points.
Oh, sorry, 5.4 percentage points specifically. I mean, who thinks of insurance liability when they look at a P&L?
You have to. If you run fleets, you can optimize the kitchen all day with algorithms, but out on the road, entropy always wins.
Capitalism is so weird. All right, well, let's get into the details of how they're actually funding all this and fighting that entropy, because there is a lot to unpack.
Yeah, so about that funding part, because you look at the, you see $120 million in projected CapEx for next year, which is, a pretty big balloon from their current run rate, mostly for corporate office investments. But they do not really take the hit for their technology innovation entirely on their own corporate P&L. They actually instituted this new fractional technology fee on their franchisees.
Oh, right. Yeah, I caught that in the transcript. It is a tiny, I think a fraction of a cent increase, like 38.5 cents per digital transaction.
Exactly. A single penny hike, bringing it to $0.385. It sounds completely negligible, but apply that against more than half of their $10 billion in U.S. system sales. It translates directly to the bottom line.
Wait, which means they effectively just outsourced their tech R&D costs right back to the franchisees.
Precisely. It just completely isolates their technology returns from the corporate expenses. And that tech, things like the new DOM OS software they use to time their dough prep, it feeds directly into their structural flywheel, which is, honestly, my absolute favorite part of this whole report.
Oh, hold on. Can I jump in? Are you talking about the store splits? Because that concept completely broke my brain.
Yes, the store splits.
Okay, so just to sanity check this, a store split is when Domino's looks at a wildly profitable delivery zone, a place where they are already totally dominating, and they deliberately just drop a second store right in the middle of that exact same map. They're quite literally cannibalizing their own successful real estate. How on earth does that make economic sense?
Look, on paper, it sounds Honestly, it sounds like self-sabotage.
Right.
You were dividing the exact same demand pie, but they found out the pie actually grows. And it gets delivered much faster. It is essentially a logistics play masquerading as real estate.
A logistics play. Right. Okay, translate that for the rest of us.
Food delivery is, at its core, strictly a math equation of time and distance. By chopping an active delivery radius in half, you cut the driver turnaround time dramatically. The driver gets back to the store faster, the pizza stays hotter, but the real strategic value is that you saturate the neighborhood so heavily, you literally box out rival stores from existing. It also makes the third-party aggregators, DoorDash and Uber Eats, work much more efficiently for them.
Okay, so it's not just defending turf. It's going on the offensive. Actually, I pulled a quote from CEO Russell Weiner about this exact thing. He said, "When we grow these stores, especially from a split perspective, two things happen. 80% of the customers that come in on carryout are incremental, but your delivery business gets more efficient."
Right. And that 80% incremental figure is massive because carryout volume actually grew 6.5% year over year in Q4. Because if you open a new store just down the street, people who would not drive 4 miles for a pizza will easily walk 3 blocks for one. So they willingly take a minor hit to the same store sales at the original location just to achieve complete density.
So it is like they are, aggressively shrink wrapping their own delivery zones.
Shrink wrapping. Sure, I would say they are tightening a control system feedback loop, but shrink wrapping works too.
Hey, people understand shrink wrap, Miro. But speaking of things they are tightening, another piece that really caught me off guard was how the CEO completely dismissed the GLP-1 headwind.
Oh, yes, the appetite suppressant drugs that are supposedly going to crater the entire junk food industry.
Exactly, because literally every other restaurant earnings call this year has analysts poking and prodding about it. But Weiner basically swatted the whole thing away. He argued that the clinical literature shows the drug's metabolic timing mainly hits breakfast and lunch cravings. And he specifically called Domino's dinner business a, quote, sharing occasion, basically implying that pizza is historically immune to the drug.
That is a very convenient, very confident narrative.
You do not buy it at all.
Well, look, I get his logic. People order pizza in groups. It's for parties, for football games. You do not want to be the guy eating a salad while everyone else splits a Parmesan stuffed crust. The social pressure kind of overrides the drug's metabolic window. But claiming you have zero evidence of impact inside the company, I don't know, it feels a bit like whistling past the graveyard while the rest of the sector panics.
Whistling past the graveyard with a stuffed crust. It is a very visual image, but honestly, it fits their posture right now. When you are somehow pulling off massive revenue growth strictly from volume, you can afford a little swagger.
Absolutely. When you drive growth entirely on order count rather than ticket padding, you have earned the right to brush off hypothetical macro risks, at least for today.
Yeah, fair point. But what happens when the weather changes, literally and figuratively? So where does this leave their actual trajectory heading into next quarter?
Well, the weather actually already did change. The CFO was very quick to pre-excuse their first quarter of 2026 strictly because of severe January storms.
Wait, hold on. So they are already lowering expectations for Q1?
Yeah, they had a bunch of closures. They are still guiding to about 6% global sales growth for the year, with the U.S. expected to bump up 3%. But that January warning, it gives them a very convenient scapegoat if the U.S. consumer finally stalls out.
Right, a built-in excuse for next time. But what about the rest of the world? Because if the U.S. is carrying the weight, international must be lagging.
It is the main weak link right now. They only project 1% to 2% growth internationally, and a huge chunk of that drag is DPE. That is their master franchisee that runs Australia and parts of Asia. It is basically in crisis management.
Jeez, how do you even fix a massive franchise operation from across the globe?
You literally get on a plane. The CEO actually joked that their head of international is flying to Australia next week to intervene. He is bringing his pillow from home.
Okay, you know a region is a mess when corporate moves into the guest room. So, stepping back, it's kind of a tale of two companies. Domestically, they're a flawless machine boxing everyone out. But globally, they're basically doing emergency plumbing.
Exactly. The U.S. engine is perfectly tuned, but look, if the international transmission keeps slipping, the overall growth algorithm breaks down. It really all hinges on execution overseas next quarter.
And if it fails, at least they packed a pillow. Anyway, I think that probably does it for the Pizza Wars today.
Yeah, that about covers the tape.
Yeah, that is probably enough damage for one episode. So if you want these earnings drops to just sort of naturally show up for you, feel free to follow the show. Keeping in mind, we do use AI to pull the filings and transcripts together so we can summarize what actually matters. And we are always looking for the next puzzle, so just drop your ticker requests at earningsunscripted@datamadness.ca or grab that X link in the show notes. Catch you on the next call.
Thanks.
See you then.